Good afternoon, members of the press, ladies and gentlemen. The Monetary Policy Committee, MPC, met on the 25th and the 24th and the 25th of September 2018 and evaluated developments in the global and domestic economic and financial environment in the first 8 months of 2018, as well as the outlook for the rest of the year. 10 members of the committee were in attendance at this meeting. The global development. The committee noted the uneven expansion in global output amidst growing trade tension, rising oil prices, and debt levels, as well as currency depreciation in most of the notable emerging markets and developing economies. These developments notwithstanding, there was evidence of resilient financial markets and output growth in the advanced economies led by the United States, which experienced sharp improvements in output growth. In the Euro area, United Kingdom and Japan, the pace of growth was moderate but steady, while in the emerging markets and developing economies, growth was sluggish and relatively uneven. Growth in the advanced economies was projected to remain at 2.4% in 2018, same as in 2017, led by the US, which grew by 4.1% during the second quarter of 2018 and is projected to grow by 2.9% in 2018. The Euro area and Japan, which grew by 0.4 and 0.7% respectively during the second quarter and are projected to grow by 2.2 and 1% respectively in 2018. In the emerging markets and developing economies, and growth is expected to remain strong at 4.9% in 2018 compared with 4.7% in 2017. Growth in the emerging markets and developing economies is expected to be led by India and China, which are projected to grow by 7.3 and 6.6% respectively in 2018. On the average, the momentum of the global economy remained on track towards achieving the 2018 growth projections of 3.9% as financial conditions remain broadly favorable with limited spillover of trade tensions amongst the general political sentiments. However, the recent episodes of large-scale flooding in major areas across the globe could pose some threat to growth. Accordingly, the Monetary Policy Committee believes that rising oil prices, tighter financial conditions, higher yields in the advanced economies, and capital flow reversals from the emerging markets and developing economies, resulting in pressure on currencies of some countries with fragile fundamentals, as well as growing tensions between the US and China, would continue to shape developments in the emerging markets and developing economies in the medium term. Domestic output development. Available data from National Bureau of Statistics (NBS) showed that real GDP declined by 45 basis points as the economy grew by 1.5% in the second quarter of 2018, down from 1.95% in the preceding quarter, but higher than 0.72% in the corresponding quarter of 2017. The growth slowdown was traceable to contraction in the oil sector in the second quarter of 2018 compared with the previous quarter. The committee noted that non-oil real GDP grew by 2.05%, reflecting the strong performance of construction, services, and agriculture, which grew by 7.66, 4.19, and 1.19% respectively. Furthermore, the non-oil sector was similarly supported by the stability in the foreign exchange market, continued implementation of 2017 capital budget, and the ongoing interventions of the bank in the real sector of the economy. The MPC was of the view that even though growth remained weak, the effective implementation of the 2018 federal government budget, capital budget, and policies that would encourage credit delivery to the real sector of the Nigerian economy may boost aggregate demand, stimulate economic activity, and reduce unemployment in the country. Developments in the money and prices. The committee noted that relative to the level at the end of December 2017, broad money M2 grew by 2.98% in August 2018, annualized at 4.47% and below the provisional benchmark of 10.48% for 2018. The growth in M2 was largely driven by growth in the net foreign assets of 18.63% in August 2018, annualized to 27.94% and above the provisional growth benchmark of 18.15% for the year. Net domestic credit, however, contracted by 4.14%, annualized to 6.27%, in contrast to the growth benchmark of 12.45% for 2018. The contraction in the net domestic credit was attributed to the 34.68% contraction in the net credit to the government in August 2018. Conversely, credit to the private sector grew marginally by 0.81% in August 2018 from a contraction of 0.13% in July 2018, annualized to 1.21% against the annual benchmark of 5.64%. The MPC observed that despite the underperformance of key monetary aggregates, headline inflation year-on-year inched up to 11.23% in August 2018 from 11.14% in July 2018. The rise in headline inflation was from food, while core inflation declined, indicating that supply-side factors were driving the price increase. The near-term upside risks to inflation remained the dissipation of the base effects, expected 2019 election-related spending, continued herdsman attack on farmers, and the current episodes of flooding which destroys crops and affect food supply and prices ultimately. In this regard, the committee urged fiscal authorities to ensure sustained implementation of the 2018 budget, to relieve the supply-side growth constraints, as well as address the flooding incidents which has become perennial on a permanent basis. The average interbank core rate declined from 9% in July 2018 to 4% in September 2018. Similarly, the average open buyback OBB rate declined from 11.44% to 4.72% over the same period. The relative decline in market rates reflected the increased statutory allocation to states and local governments and maturing securities. The development does not seem to have been significantly transmitted to retail interest rates, as average maximum lending rates marginally declined to 30.93% in August from 31.09% in July 2018. Similarly, average prime lending rates decreased to 16.65% in August from 16.83% in July 2018. The weighted average deposit rate also declined to 4.57% in August from 4.47% in July 2018, widening the spread between the average lending rate and average weighted deposit rates to 26.36% in August 2018 from 26.30% in July 2018. The committee noted the decrease in external reserves to 44 billion in September 2018 from 45 billion at the end of July 2018. Total foreign exchange inflow through the economy fell by 38.34% to $6 billion in July from $9.73 billion in June 2018. Committee believes that accretion to external reserves should strengthen in the last quarter of 2018, with crude oil prices remaining above the budget benchmark price of $51 per barrel and oil production increasing to 2.3 million barrels per day. The committee noted the relative stability in both the investors and exporters window of the foreign exchange market, which was sustained by autonomous inflows and measures taken by the central bank to deepen the foreign exchange market and curb speculative practices. The MPC expressed concern at the decline in major capital market indices. The all-share index decreased by 14.99% to 32,540.17 on September 21, 2018, from 38,278.55 at the end of June 2018. Similarly, market capitalization decreased by 14.33% to 11.38 trillion naira in September 21, 2018 from 13.87 trillion naira at the end of June 2018. The development was due largely to sustained profit taken by portfolio investors and capital reversals as foreign yields become increasingly more attractive. The overall outlook and risks. Available data and forecasts of key macroeconomic indicators show a positive outlook for the economy in the third quarter of 2018. The committee expects the sustained implementation of the 2018 budget, improvements in the security situation, and sustained stability in the foreign exchange market will stabilize prices and strengthen economic growth. Growth in the non-oil sectors, especially agriculture, manufacturing, services, and light industries, are expected to drive output growth. Committee, however, identified the downside risks to the output to include the impact of increased monetary policy normalization in the advanced economies and the strengthening US dollar. Others are delayed implementation of the 2018 budget, weakening demand and consumer spending, build-up in contractor debt, low minimum wage, impact of flooding on agricultural output and other economic activities, continuing security challenges across the northeast and north central zones, and growing level of sovereign debt. The outlook for the year, however, remains positive as the economy is projected to grow by 1.75% in 2018, anchored on continued stability in the foreign exchange market, sustained high price and production of oil, and improved electricity supply. Inflation outlook suggests a mild resurgence of inflationary pressure in the economy, traceable largely to cost push factors, election-related spending, amongst other domestic factors. The moderating factors to the outlook would include improved power supply, increased expenditure on capital projects, and improved security conditions, all of which may exert downward pressure on consumer prices in the near term. The considerations of the committee. The committee appraised the macroeconomic environment and noted that at its July meeting, modest stability had been achieved in key indicators, including inflation, exchange rate, and reserves. In particular, relative stability had returned to the foreign exchange market, buoyed by a robust level of external reserves, with inflation trending downwards for the 18th consecutive month. These gains so far achieved appear to be under threat of reversal following the new data which provides evidence of weakening fundamentals. The committee identified rise in inflation and pressure on the external reserves created by the capital flow reversals as the current challenges to growth. It noted that inflationary pressures have started rebuilding and capital flow reversals have intensified as shown by the bearish trend in the equities market, even though the exchange rate remains very stable. The committee was concerned that the exit from the recession may be under threat as the economy slowed to 1.95 and 1.50% during the first and the second quarter 2018, respectively. The committee noted that the slowdown emanated from the oil sector with strong linkages to employment and growth in other key sectors of the economy. In this regard, the committee urged government to take advantage of the current rising trend in oil prices to rebuild fiscal buffers. Pressure on food prices would gradually begin to recede, while growth-enhancing measures would, over the medium term, have some moderating impacts on food prices over the medium term. The MPC expressed concern over the potential impacts of liquidity injections from the election-related spending, an increase in FAC distributions, which is rising in tandem with increase in oil receipts. Committee was concerned with the rising level of non-performing loans in the banking system, traced mainly to the oil sector, and urged the bank to closely monitor and address the situation. It also expressed concern over the weak intermediation by deposit money banks and its adverse impact on credit expansion and investment growth by the private sector. In view of the above developments, the MPC noted that the economy was still confronted with growth challenges and inflationary pressures. It reiterated the need for synergy between the monetary and fiscal policies as a viable option for macroeconomic stability. The committee therefore identified two likely policy options as tightening or maintaining the status quo ante. Tightening would tame inflationary pressures, stem the reversal of portfolio capital, improve the external reserves, and maintain stability in the foreign exchange market. Conversely, the MPC felt that raising rates would further weaken growth as credit would become more expensive, non-performing loans would increase further, leading to a deceleration in output. In the committee's opinion, the upward adjustment would not only signal the bank's commitment to price stability, but also its desire to maintain positive real interest rates. A decision to hold all policy parameters constant would sustain gradual improvements in output growth. There is need to maintain the current monetary policy stance and await a clearer understanding of the quantum and timing of liquidity injections into the economy before deciding on possible adjustments. The MPC, however, called on the government to fast-track the implementation of the 2018 budget to help jumpstart the process of sustainable economic recovery and to facilitate passage of the petroleum industry bill in order to increase the contribution of the sector to overall GDP. The committee's decision. In the light of the above, the MPC decided by a vote of 7 members to retain the MPR at 14%. However, 3 out of these 7 members voted to raise cash reserve requirement by 150 basis points, and an indication that left to them they would indeed tighten. The other 3 members voted to tighten by raising the MPR by 25 basis points. In summary, the MPC voted to 1. Retain the MPR at 14%, retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR, retain the CRR at 22.5%. I repeat, notwithstanding that 3 other members would have loved that the CRR be raised to 24% to tighten, to actually signal that they would prefer to tighten. And 4, retain liquidity ratio at 30%. I thank you for listening.